Well, the surge in the stocks that we've seen in the first quarter of 2019 really comes on the heels of how weak things were in the fourth quarter of 2018. The U.S. equity market was exceedingly weak in the fourth quarter. Midstream or MLP stocks were not immune from that when they traded down about 15% in the fourth quarter. Yes, we've rebounded here in the first quarter of 2019. The sector is up over 25% since its Christmas Eve low. But keep in mind, we're only back to the levels that we were at in the middle of October of last year. These stocks are still at very cheap valuations and still exhibiting double-digit cash flow growth. We had record cash flows in 2018. We should have record cash flows again in 2019. And yes, we've rebounded, but I would put forth that the rebound certainly could have some legs as we look out over the balance of 2019. On a relative basis, MLPs or midstream companies are, I think, exceedingly attractive. If you look at the yield of the sector, it's around 6.5%, and that would compare to REITs at around 4% or utilities at around 3%. And then you look at cash flow growth rates for 2019. Midstream companies should have more than double-digit cash flow growth in 2019. That would compare with REITs, which should be about flat, and utilities, which should be up around 4%. So you've got higher yields, higher growth, and very importantly, lower valuations. You look at cash flow multiples for midstream companies, and right now they're trading at a 23% discount to where they historically have traded at, and that would compare to utilities and REITs, which are both trading at between 15 and 20% premiums to where they've historically traded at. So I think the combination of lower valuations, better growth, and higher yield certainly does position the sector well over the balance of 2019. We remain very constructive in 2019 for midstream or MLP companies, and that positive bias towards the sector is really a function of growing U.S. energy production, which is growing cash flows for the companies that we invest in. It's allowing these companies to raise their distributions, albeit at a slower growth rate than we saw 4 or 5 years ago. But you've got a sector that has valuations that are at 23, 24% discount to the historical valuations, despite the fact that the fundamental landscape is as positive as it is. Balance sheets are deleveraging, distribution or dividend coverage ratios are rising. These are all attributes of a sector that should be trading at least parity, if not a premium, to its historical multiples. Yet here we are with these stocks continuing to trade at a discount valuation. In our view, if the cash flows come in as we expect they will, and they have so far, that disconnect between cash flow growth and a lack of share price appreciation is bound to get bridged. Now, whether that happens in a week, a month, or 6 months, I'm not quite sure, but certainly that disconnect between cash flows and stock prices is unsustainable if the cash flows come in as we expect they will.